Today we are going to be talking about split testing and walk forward optimization in depth so that you can backtest your models properly. Since some of you were actually having trouble with how to split data, how to ensure that you are backtesting it in the right way. Right now, let's talk about it. It's two main core ideas of backtesting into one file. Right now, what will you learn? Part A splits 3 cents of evaluation and everything. Part B will be your walk forward optimization. Now, this is the setup, right? This is the imports and configuration, how you can do that. This is the code for that. Then once your data is loaded, we use 15 years of S&P 500 data, long enough to host several train test, valuation, holdouts, and at least 5 walk forward splits. Now, as you can see, this is the adjusted close data. This is the daily returns. Now, let's talk about the strategy and helper function you have used throughout. Now, we will keep coming back to one toy strategy that's going to be the SMA crossover. Why am I using the SMA crossover? Because it's basic enough for people to understand. And if some people in the cohort are already good with coding, they can even manage better strategies. But the core ideology is to understand the walk forward and split test, right? Now, the phase one. This is the beginner's primer. Before we touch splits or walk forward, here are the foundational ideas you need in every line of this book to make sense, right? Now, what is strategy in code? A trading strategy at its core is a rule that turns prices into a position over time. It's simple, right? Now, the position tells you for each bar either you're long, you're flat, or you're short. Multiply with that position by the next bar return, and you get the strategy's return. Compute two moving averages, shift the signal by 1 bar. Now, what is the difference between prices and returns? Prices is the level that the rupee or like the US dollar or let's say euro the asset is trading at, or and return is percentage change between bars. Trend in prices it's stationary, in returns it's mostly noisy around zero, stationary-ish. So comparable across assets, no, but returns can be compared with other assets. This is used for signals and this is used for performance, risk, and statistics. Now the equity curve, the growth, how it grows, Sharpe ratio in plain English. I've talked about Sharpe ratio as well. Now the Sharpe ratio is how much excessive return you earned by per unit of risk. Your average return divided by standard deviation into multiplier analyzes a daily, weekly, monthly figure. Now, the rule of thumb: if you have a less than zero Sharpe, you're losing money, or negative Sharpe, you're losing money. If you have 0 to 1, it's mediocre. 1 to 2 is good. 2 to 3 is very good. And if it's any day above suspicious, check for bugs, overfitting before celebrating. You might have unlocked a lottery, but it might not be a lottery. It might just be a fuck up on your part. Now, drawdowns basically from peak to trough. Basically, this is your drawdown. Simple, right? As you can see right here, from here to here, it was a drawdown period. Here to here, it was a drawdown period. Again, 2020, massive drawdown periods. Now, other performance metrics we will see through all this is CAGR, volatility, Sortino, Calmer, win rate, and profit factor. Look ahead bias, overfitting. We have talked about this. This is included. Now, the main topic in this: parameters versus hyperparameters. In machine learning, parameters are the model, are what the model learns automatically, the weights. Hyperparameters are the knobs that you tune: learning rate, depth, regression. In a trading strategy, there is usually no learning step. Every knob is a hyperparameter by you or your optimizer. Fast, slow in your SMA, basically fast length and slow length are your hyperparameters. The optimization we do in this notebook is hyperparameter selection. Now, what is a regime? A regime could be 2003 to 2007, low volatility equity bull, carry works. 2008, volatility spikes due to correlations. Almost every stock and asset correlates to one. Basically, if all are going down, if one is going down, everything is going down. Momentum trend dominates. Zero rates in 2010 to 19, FANG dominance, mean reversion thrives. Then 2020 was your pandemic shock. 2022 was your rate shock regime. Now, difference between backtest, paper trading, and live test. In backtest, the data is historical. There is no money involved. Walk forward backtest, again, historical, no money involved paper trade. We trade live after creating that strategy, but on a demo account, so no money is involved. Live small, we start with small capital. This is the actual phases that you should try, rather than just making a strategy and deploying it live to let's make money, right? Now, stationarity and autocorrelation, quick mental model. Stationarity is basically a series where statistical probabilities don't change significantly over time. Daily returns are roughly stationary, prices are not. Autocorrelation is how much a value at time t depends on a value at time at t minus 1, t minus 2. Prices are highly autocorrelated. Returns much less so, but non-zero like volatility clusters and momentums do exist. This is the mathematical reason shuffled k-fold leaks. We will be talking about k-fold and leaks in this, maybe in this, but definitely in basics of ML as well. Now, how to read this notebook? Plot consists of a consistent color code. Blue is train in sample data, green is validation, orange is test or out of sample, gray is the benchmark. Gray line is the benchmark. Now, part A. Basically, why do we actually use the splits? The core idea is a model that has seen its evaluation data is no longer being evaluated. It's already graded on its memory. Consider it in a way, you're basically you have a student and they have a exam in a few hours, and you're asking him or her to prepare for the exam, but instead of the student going through the entire syllabus, you already gave him the question paper, so it will train itself according to the question paper, right? But the question paper was your historical data set, but the future live markets will be out of syllabus for the student, right? Now the words that you will hear throughout this video: train, validation, test, in sample. Train is the data where the model trains it, basically fits on, right? Validation is basically how where we use the data to hyper tune to tune the hyperparameters. Now the test is a holdout period, data that touched once at the end to estimate what would be the live performance. In sample, again loose, but similar to training. Out of samples, synonym to test. Now cross validation is we split the data repeatedly to calculate a robust score estimate. Now k-fold, it splits data into equal k chunks, each takes a turn as test and then train, test, train, test, train, right? Now, leakage is basically when the data from your test series, which is like which should not have been leaked or seen by your model, leaks into your training. Now, purge is removing training samples whose labels overlap with the test window. Embargo, why do we use embargo? It skips a buffer of bar right after each test fold. Basically, 2016 to 17. Then we embargo 6 months data, and then 2017 mid to 2018 we start the test again, right? Now, let's talk about ML splits versus time series. Generic ML assumes data points are independent and identically distributed. Cats are cat, order doesn't matter. So they can shuffle and randomly split without an issue. But again, financial data is nothing like that. It's sequential, auto-correlated, non-stationary, and especially the highlight, it's regime dependent. 2008 data is not 2014. 2022 20, there was a COVID crash which might or might not ever happen again. Again, a regime dependent, right? Treat finance like, that's why machine learning in finance is one of the most difficult things that you could do. And I see a lot of people directly hopping onto ML, which is not easy to do. You have to go through an entire process. You have to trust the process and then go to ML, not straightforward start with ML. Now, phase 2, the 3 sins of evaluation. If you skip splits or do them wrong, you will fall into one of these 3 traps. That's why quant ship strategies that look magical and lose money on day 1. Now, the sin 1 is using in sample data only. So you're basically taking the entire data set and training your model into it. Definitely you will find the best parameters which yielded the best returns, but will it be yielding the same return in the future? Maybe not, right? Let's say A 12 and 36 SMA had the highest returns over the past 10 years, but there is no necessity because it's not identically, it's not double ID data, right? That's why you have to understand that the parameters that worked before may not work in the future. That's why we create robust strategies. We do fragility tests, we do robustness tests. Now, SIN2 is contaminated splits, basically leakage in the data. You technically have a test set, but information from it might have crept into your training pipeline. So, you standardizing the full data sets means standard deviation before splitting, using future values of an indicator to label past events. Basically, a sort of look ahead bias that can create overfitting. Now, the SIN3 is peaking, basically test, set, burn. You evaluate on the test, get a bad score, tweak something, evaluate it again, repeat. Every peak leaks information from the test to the researcher that you will again use it in your model. After 20 iterations, your test set is just another training set wearing a mask. Basically, if you are regularly trying to make sure that your hypothesis is working out, xyz, any possible way you are making sure that your hypothesis is working out, maybe hyper tuning the parameters or something, your hypothesis is not working, you have to create a new one. You're just overfitting to the data. Now, this is the visualization of SIN2 standardizing before splitting. As you can see right here, this is leaky and this is clean data. Now let's talk about phase 3. What do I mean by phase 3? Train, test, split, concept diagram. Basically, let's say this is your entire data set. You use 70% of it to train and test it on to validate your strategy on 30% of the data. Why it is the default for time series. You can also use 50-50, 60-40, up to you and the data that you are training according to it. Yeah. Now, why it is, let's say I was talking about embargo, right? If I cut the data here instead of here, right here, this area would be embargo. Now, why is it right default for time series? Order is preserved. It mimics how the model would have been actually deployed, developed in the history, not traded on the future. It's trivial to reason about, one number to report. Common ratios are 70-30, 80-20, 60-40, 50-50. Right? Small data, use walk forward instead, because like a single split is too noisy for that. This is like a chronological 70-30 train test split from 2010 to 2026. As you can see right here, this is the train data. This is where our model will be trained, and this is exactly where it will be split and validated on this area. Now, let's talk about train validation and test. See, now what we will do is we will use 60% of the data to train the model, then 20% to tune the knobs of the model, and then 20% as a final validation score. Train the model fits on this, validation used repetitively, as I said. Now, why you almost always need this? If you run any kind of grid search, hyperparameter optimization, grid search, very easy to overfit, hyperparameter optimization, very easy to overfit. The winning configuration was chosen because it scored best on whatever set you compared it to. That set has been burned. If you only have train tests, you have just turned the test set into a validation. Right? As you can see, the chronological split for this: train, validate, and then test. Now, phase 5 is your splits in action on a strategy. Optimize fast, slow on train. Pick the single best parameter set on validation, and then report sharp drawdown and equity curve or the set test set. This is the minimum acceptable evaluation pipeline in backtesting. As you can see right here, then validation. Why is the sharp ratio so high? Because we chose the best parameter, hyperparameter that was best on the validation period, and then ran it on test as well. Whereas you can see there is a huge sharp ratio degradation, which is definitely not acceptable. Now let's talk about, yes, if train validation test sharps look something like this: 2.4, 1.1, and 0.4, the strategy is overfit. Validation caught some of the optimism, but the test set told the truth. If it looks something like this with minor degradation on minor changes, 0.9, 0.8, 0.7, the strategy is boring, but it's real. The edge is real. Now, phase 6, why k-fold breaks on time series. What standard k-fold looks like. So a standard k-fold cross validation shuffles all the row and split them into equal parts, right? Each part takes a turn as the test fold while remaining k minus 1 from the train fold. Now, why is it catastrophic for finance? Some folds train on future data and evaluate on past data, which is basically sneaking on the future, which in a live market you won't have the future data. Right now, even non-shuffled K folds leaks via autocorrelation between adjacent bars. This is where you can see all the splitters side by side. This is something of a bit complex concept. If you are understanding it, well and good. Otherwise, I will make an entire video dedicated on this as well. Now, let's talk about time series expanding and rolling. What do I mean by an expanding window? As you can see right here, this was a train and this was a test. Then the train expanded to till here. The test was pushed forward. Now, again, fold 3, train was pushed more, expanded more basically, right? Train always start at the same points but grows as it goes. Now, rolling is basically fold 1, then test, and in place of test, train, then rolling the test forward. Same idea as walk forward optimization but in rolling mode. This will be covered in depth in part B as well. As you can see right here, expanding windows, the blue line is just expanding more, and then rolling windows, we are just shifting the entire data set. Like the back test on, let's say it started from 2015, we're shifting it to 16 now, then 17, right? Now, purged and embargoed k-fold, the subtle leak even time series has. Suppose your label for bar T is the return over the next 5 days, then bar T minus 1 label and bar T minus T plus 3 labels both depend on T to T plus 5. If T minus 3 is in train and T plus 3 is in test, the labels will overlap. Test information has leaked into training. Now, the two fixes that we use from Marcos Lopez de Prado, goat of quantitative finance for me. Everybody is entitled to their own opinion. We will be using Lopez de Prado's methodology entirely in ML. I'm making the ML video next. Now, two fixes. The first is purging for every test bar. We remove training bars whose label window overlaps with the test bar label window. Now, embargo. Additionally, we add a buffer, right? A small buffer between the two data sets right after each test to kill leakage. So this data set isn't leaking into this. We create a small gap. So this is like taken out completely, right? As you can see right here with 2% embargo, there is an embargo here, there is an embargo here, there is an embargo here, and here as well. Now, when to bother? Purging plus embargo matters when labels span multiple bars. Bars are highly autocorrelated and you are training ML models that aggressively memorizes the data. The decision tree, which split to use? Are you training a time series strategy or model? No. Standard k-fold or stratified k-fold is fine. Will you tune any hyperparameters? No. Train, test, chronological split is fine. Yes, train validation test is required. Now, are your labels multi-bar or overlapping? No. Time series CV is okay. Expanding and rolling window is more than enough. If yes, you need purged k-fold and embargo. For trading strategies, especially walk forward optimization is the gold standard. The other methods are all approximate parts of what walk forward optimization does naturally. What is a walk forward optimization? The definition for it. Walk forward optimization is a backtest validation method that simulates how a strategy would actually be deployed, optimized on the past data, and trade on the very next unseen segment of data, then rolls forward and repeat the entire process. If I had been retuning my strategy every month or quarter on the data available at the time, what would my track record actually look like? How would I have been profitable? Every single trade in your final equity curve was placed using parameters chosen without ever seeing that trade's data. Why it differs from a normal backtest? You're grid searching entire history, picking the parameters that gave the best Sharpe ratio and showing the results as an equity curve, which is again useless. That's circular. You use the result to pick the parameters, then claim the results as evidence. Those results were highly overfit. Now, walk forward optimization breaks the loop completely. Now, the vocabulary used in this, we've talked about this, the anchor WFO. So, the in sample will start from an anchored point and then roll or expand, basically expand into the future over time. Now, rolling WFO is a fixed length window that will just, if it started here, now it will slide to this part. That's simple, right? Easy. Now, what is step size? Basically, how much, like let's say, um, how big of a step it will take, like when climbing the stairs, right? The step of a stair. So basically, how much the data will be pushed when it's taking a step. That's your step size. Easy. Now, walk forward efficiency out of sample divided by in sample performance. Now, it will be calculated on stitched out of sample data, which will be concatenated out of sample returns your honest equity curve. As you can see here, the final equity curve will consist of out of sample 1, out of sample 2, out of sample 3, and so on. Now, phase 10, the overfitting trap, the story that every quant has lived through. You build a SMA crossover, you sweep for hyperparameters, and you pick the best one because it gave you a sharp ratio of 2.3, which is useless. You go live, strategy makes nothing, or worse, it gives you a drawdown. Now, what will happen out of 700 parameter optim combinations? I've seen people running grid searches with 7 million backtests as well, right? So imagine the possibilities of overfitting. At least if you are running 700 combinations, of course there is a possibility one will look crazy good. Consider in a way, I'm Ted, I'm a quant in this timeline and there are infinite timelines. So if I'm searching in infinite timelines, like which Ted is billionaire in XYZ timeline, or out of 10,000 timelines, in which timeline is Ted a billionaire? And of course, in one of 10,000 possibilities, of course, I might be a billionaire. I mean, I want to be, but still, yeah. Now, talking about the numerical demo, the best sharp grows with the number of trials. We generate pure noise, try n random parameter set and plot the best in sample sharp so far versus n. The number is monotonically increasing. By definition, you keep the best one even though the underlying edge is exactly 0. Now, this is how optimizing over noise, the more you try, the higher it lies to you. Why walk forward optimization fixes this? Walk forward never lets the optimizer see the data it will eventually be judged on. Luck doesn't carry into the next out of sample window. The out of sample returns reveal the fact. Now, what do we use? Either the anchored or the rolling. It's like it depends on you which approach you want to take. Anchored is an expanding window. It expands to this, then this, then this, then this. Auto sample starts at the same point. Every iteration grows over time as the history accumulates. More data, more statistical power, more stable parameters, but slow to adapt to regime changes, like we mentioned in 2020, 2008, right? Rolling window has a fixed length. Old data just falls off the test entirely. Adapts faster to regime. Smaller sample could lead to noisier optimization, which you should use. Slow structural, basically macro strategies, anchored is preferred. Fast regime sensitive, basically intraday strategies, rolling is preferred. You suspect that market has changed character permanently, rolling is preferred. You want maximum statistical power, anchored is preferred. Now, the anatomy of a walk forward optimization is specified by 4 numbers. In sample length, then it's your auto sample length, step, how far we advance each iteration, step right, mode, anchored or rolling. This is how the anatomy looks like. Sizing rules of thumb. In sample length is more than or equal to 10x the longest parameter you optimize. Auto sample length large enough for several trade, small enough that the regime doesn't fully change. So the 20 to 40% of in sample is typical. More than or is equal to 5 splits for any conclusion, ideally use 10 plus, right? Visualizing the splits before running, this is how a rolling would look like. So it falls, the previous data just falls off, right? As you can see, right here, right here, right here. Now the anchored one will anchor at the same point and will just expand over time. Now, naive single forward optimization is where you could go wrong. Now let's talk about full history optimization. Some dumb fucks would actually do this, find out on the entire data set full history, optimizing it, which sharp was the best using those parameters, fast 5, slow 190. That number is a lie. It was chosen with the full knowledge of what will happen exactly in the future. Now, anchored WFO from scratch. This is how you can build it for yourself. The code is right here. A few people were struggling with the code. I've included the codes. Please go through the video and especially go through the notebooks. They are attached below the video. You can download them and use it for yourself. Now, phase 15, rolling WFO from scratch. How does the stitched outer sample versus the naive backtest look? Buy and hold, naive, anchored, rolling WFO. These are the results. Buy and hold, naive, anchored, rolling, right? As you can see, rolling is much more faster to adapt to market regime shifts. These are the sharp ratios for them. Now, we talked about walk forward efficiency before. Walk forward efficiency is the single most useful number to report from a WFO run. Out of sample divided by in sample metric. If it's above 0.6, it's genuinely reversed. If it's between 0.3 to 0.6, it's fragile but plausible. You have to do other tests to remove the skepticism of the strategy. If it's less than 0.3, it's certainly overfit. If it's less than 0 or strategy lost on out of sample while making in sample, a classic curve fit. Again, this is your robustness test, remember it. These are the results for it. This is the bars, rolling bars, anchored bars, right? Now, parameter stability. If the optimizer keeps picking wildly different parameters every split, your strategy is essentially picking noise. Robust strategy should produce cluster of similar parameters throughout the time. Visualize it in two ways: scatter of fast and slow and time series of the chosen parameters. Yes, right here, as you can see, right here, right here. Now, tight cluster plus green dots, robust strategy out of sample is consistent. Spread out and mixed colors, spread out and mixed colors. Optimizer is failing, you're mining noise. Tighter cluster but red dots, the strategy consistently fail out of sample, but at least the signal is honest. Now, the common pitfalls for both of the topics is pre-processing the entire engine before splitting. Split should be your number one step. Now, look ahead bias. How do you avoid it? By shifting the signal by one. WFO does not save you from a bug that uses today's close to trade previous close, right? Now, reusing the test set, every glance at the test set is a tax on its honesty. Above 5 evaluation, you're effectively turned it into validation. Reusing auto sample to pick the best WFO configuration. Some quants, what they will do is run the WFO with multiple length settings and then pick the one whose auto sample curves the look best. This is meta overfitting. Now pick your WFO configuration before you look at any results. Take tiny auto sample, tiny test sets, useless. Ignoring costs like spread, commission, swap. Optimizing for sharp only. Use multi-metric, right? You can create a confidence score. Sharp, calmer, drawdown. Good enough. Now the stratified k-fold on time series stratification preserves class balance by shuffling. Don't. Now picking the best strategy across many train test splits. Running 50 strategy and reporting only the best sharp is a selection bias on the test itself. Pre-register the strategies or apply a multi-testing correlation. Monomorphy like deflated sharp ratio. Forgetting about regime changes. Anchored WFO is slow to react. Visualize the chosen parameters over time to ask whether the answer has a solid economic sense and rationale. Now, what do you have? 3 working split strategies, chronological, 3-way time series CSV, a demonstration of how shuffled K-fold leaks on the future financial data, a toy implementation of purge K-fold embargo with embargo a brilliant way to use and a brilliant methodology for MLs. A from scratch anchored WFO engine, a side by side comparison of WFO against a naively optimized backtest, walk forward efficiency, parameter stability, diagnostics, and a list of traps that can destroy results in practice. The recipe in one: split honestly, tune on validation, retune throughout time. Trust the auto sample only. These are the glossary for what we have talked about. These are the suggested next steps, the further readings, the probability of backtest overfitting, advances in financial machine learning. Next video will be on, hopefully on basics of ML, right? Now, that will be all for the day. Thank you so much, guys, for your time.